Good morning, Wealth Advocates Nation. It's great to be back with you, and welcome to 2025. I'm here with these geniuses, John Mickelson to my right, Brad Harsh to my left. Brad's our director of trading. We don't see his face often enough on these podcasts. John and I, maybe we see it too much. Who knows?
Probably.
Hey, our topic of discussion today is proactive tax planning. This is an exciting topic. And because we're in tax season, this is the topic everybody wants to cover anyway. What could I have done to keep more money in my own pocket? John, talk to us about the difference, first and foremost, the difference between tax planning and tax preparation.
Yeah.
Because we don't do one of those.
Yeah. Well, so putting it in perspective, remember that of the areas we really focus on, estate, everything else, tax is a big piece of it. The intent is, how do we make you as efficient as we possibly can be?
Correct.
And there's a big difference between tax avoidance and tax evasion. We don't want to go to that other area. We want to do things that we know will work. So, as we look at the planning, a big thing is going to be looking at what elements give us control over two major areas. One is your income tax bracket and your income tax that you pay. The second one is the efficiency within your portfolio, which Brad will be able to speak to a little bit as well.
But okay, well, the 2025 tax brackets are out. IRS has released those. IRS laid off 6,700 people today.
Yeah, I know.
At this recording, by the way. So maybe you won't get audited. I don't know. So those tax brackets for the first $11,925. If you are single, you don't pay taxes on that. If you're married, filing jointly, good job. Keep that marriage going. The first $23,850, you do not pay taxes on. At the very top is the 37% tax bracket. And that means that anything over $751,600, if you're married, filing jointly, you're going to pay the top tax bracket on it. If you're single, anything over $626,000, $350, congratulations, you're doing really well, but you have to pay the top tax bracket. Now, this is a step. So it's not, oh, I made $700,000 this year, so the entire thing I pay at 37%. You know what we do? We're going to zero in on what you're paying in taxes. We're going to run it through our calculations, and we're going to see exactly what your effective tax bracket is going to give you a single page summary and explain to you how your taxes work this year with a whole host of ideas on what we can do next year. So let's dive into it. I just talked about income tax. We had to talk about capital gains too, because that's the other half of the equation. John, walk us through capital gains.
Well, keep in mind that there's basically three levels of tax. There's your ordinary income tax, your capital gains tax, and then there's estate, which is a whole different ballgame. But your capital gains rates generally are lower, but if you're down in the brackets below 22%, there's not much difference. And I think people always assume that capital gain rates are going to be lower. And so I think that's a big part of how we plan. If we can open up more investments because we don't have to focus just on ones that produce capital gain, that gives us a lot more flexibility in how to manage the taxes and the investments in harmony. So that's a big part of it, is just knowing what to invest in and where the taxes are going to hit. The other thing to keep in mind is that 22% bracket is a big pressure point. You look at the brackets, that jump from 12 to 22 is the biggest, and it's the one that hits the vast majority of people intentionally. I mean, that's where the sweet spot is for the government to say, how do we collect more tax?
For sure.
And we can do a lot of things from a strategy perspective to help mitigate some of those numbers. But isn't it correct that there's a big difference between, the tactics that we would use to either generate capital gains where they need to be, or to wash capital gains where they need to be.
Gain loss harvesting, for sure.
As well as asset placement, doing certain types of strategies that have certain outcomes in certain types of either taxable or non-taxable accounts, right?
2022, 2023, 2024, that was a great example of that. 2022 was the year we had a lot of losses. So we were able to reposition assets in similar places, recognize gains. What did that do to 23? We had a great year in 23. And then we were able to use all those losses against all the gains. And it helped us be a lot more efficient tax-wise. 2024, a lot of those losses were all used up. So now we have to be a lot more careful about what we sell and what we keep.
Right.
let's walk through a couple different strategies just at a high level that apply to a lot of people, and understand that everybody's circumstances are individual. And I highly urge you to give us a call. Let's sit down and talk about your individual situation. So let's talk about retirement plans. Retirement plans, there's exciting things going. If you're still working right now, what's happening in the retirement plans? Brad, can you walk us through contribution limits and where those are at?
Yeah, you need to get my glasses for this one.
Well, there they are.
Okay, so contributions to 401ks, which are called elective deferrals, up at $23,500. Defined contribution plans, which are going to be a little bit more advanced structure,
sure.
but at the same time can deduct as much as $70,000 as far as those contributions.
So let me put that. So the 23,000 is you coming from your paycheck. That's deferrals out of your pay.
Right.
The money above that, up to 70,000, is going to be the employer putting money in. And if you're self-employed, that can be you on both sides. So that's where I think it's important to see, hey, there's two elements to this, to how to get to those high numbers.
Simple IRAs, another great area for
Great idea.
for deductible
Small
contributions
businesses,
at $16,500. You've got some good skill in this area in terms of structuring those and
Those
knowing
are
how to
great little plans. They're small. They're 401ks for small businesses without all the costs. Love those.
Yeah.
Yeah, I'm old enough to remember when a typical IRA contribution was $2,000.
Oh,
So I'm happy to say that I can read off the page now that traditional IRAs have a contribution limit of $7,000.
but let's talk about these catch-ups. That's really where I want to
Yeah,
get
it
to
is.
in this conversation,
Yeah.
because most of our people, the vast majority, are going to have a 401k. They're going to have a traditional IRA. Maybe they have a simple IRA because they work for a small business owner. And then they graduate to 50 years old and they get to participate in this catch-up clause, right?
I can't wait. Just kidding.
Throwing down the gauntlet.
I might have already gotten there.
And those,
All right.
those catch-up contributions for 401ks are about $7,500.
Yeah.
Mhm.
Okay. For simples, the catch-up $3,500.
Yep.
For regular IRAs, the catch-up contribution is $1,000. And then there's a good old super catch-up for anybody age 60 to 63.
Hang on. This is brand new to 2025. It is such a unique nuance. It applies not if you're 59 and not if you're 64, between that band of 60 and 63. I don't understand the rationale, but it is either 100% of, it's 150% of what it could have been.
Yeah.
Your catch up could have been, all the way up to $10,000. So whichever is higher. That's a very unique thing for the IRS, because they always say whichever is lower. 150% of what you could have done as a catch up, or $10,000, whichever is higher. Only if you're 60, 61, 62, 63, 64, you're out of the game. That's too bad.
All right.
Yeah.
Is that the strangest thing?
Yeah, it
Yeah,
is.
it's rare to
The
have
super
something-
catch up, brand new to 2025. I really wanted to highlight that. Okay, so John, how about gifting? Can you walk us through that?
Yeah. So gifting, we're shifting a little bit to the estate side of things. And that is not income tax, not capital gains tax. We're talking about if I want to transfer money to one of you or to my kids or to anyone else, there is a limit that is imposed on us. And we can put, there's one that's a annual, use it or lose it. And then there's one that's lifetime. And so the year by year, we've now gone up to $19,000,
Which
per
is a huge
person.
deal if you have an irrevocable life insurance trust, or if you're gifting to your kids.
And it can be
to move
gifting
things out.
like elements of land or a
Yes.
business. I mean,
Yes.
bigger assets, a farm, a ranch. I mean, that's,
Farm. Good
and
example.
remember, it's per person. So if I and my wife want to give to one child, she can give 19,000 and I can give 19,000. The other thing we could do is say that child, if they're married, I can give the other spouse 19 and 19 as well. So think about how that can compound. You can shift money into a successor's name a little at a time, year by year. But then the amount for annual, what is it this year? We have it on there?
The amount for annual is 19,000, right?
Well, but the lifetime, sorry.
Oh,
the
the
lifetime
lifetime.
amount.
It's like 28 million, 500, I believe. It's way out of the,
For now.
it's more than my estate.
Yeah.
I could do
but
the
but what I mean by
19,000.
for now is we don't know what it will be next year.
Yeah.
We are having a
Why next year? Why next year? What's significant? We're going to really talk about the Tax Cut Jobs Act
Yeah.
in a minute. But
So all these rules that exist right now were implemented back when Trump was in office the first time. And they put what's called a sunset provision, which is a very elegant way of saying it's going to go away.
Yep.
At some
Speak.
point.
We're not going to raise your taxes. It's just going to evaporate.
Yeah.
Into the
So then,
sunset.
of course, whose fault is it? Nobody really
Nobody's.
knows. It's
We
nobody's
couldn't do
fault.
anything
It just
about
went
this.
away. So that's really frustrating for anybody that has to do planning, because it affects that gift that I just talked about, the $19,000.
Yeah.
It affects the lifetime
For sure.
gift. It cuts that basically in half. That's a big deal. And then the other thing is all those tax brackets, income tax brackets, and your capital gains tax brackets you'll hit the higher amount sooner, and they will be higher percentage.
So how long is it until we find out whether the sunsetting
year.
privilege is?
Yeah, we don't know.
But
I mean,
wait, there's a
it-
time
it
limit.
expires
When's
at the end of the
sunset?
year.
When does the sunset occur?
December 31st of this year.
Yes. So we're into it. We're into it this year.
Yeah.
And does it get extended? It is the same cadre of people that created it that are in office again now. So who knows?
Now, the question is, what will they say? Hey, we can't let that go. We need to make that permanent, or we need to extend it.
Well, the reason why there's a sunset, that magical political term in there, is because it doesn't financially work.
Yeah.
It doesn't financially work, and that's the only way they could get this to pass the Office of Management Budget, the OMB, is to have a sunset provision. This is a little gift to the American people, but only
It can't
for so
last
long.
forever. Yeah,
it can't
yeah,
last forever.
yeah.
So making it permanent has significant economic implications. All right, so we're in it. We're in it right now. We don't know how long we're in it. We need to talk about proactive tax strategies. And because we're doing a podcast and because it's going out to the world, we're going to talk about big, fat, generic stuff that's not going to get us in trouble. Well, let's talk about individual stuff that will get us in trouble one-on-one. What do you say? Okay. So the Tax Cut Jobs Act in 2025, what can we do? Well, we had to talk about required minimum distributions. Brad, what are those?
Required minimum distributions are forced upon people as we age, so that we're forced to pay tax.
Yeah, we want our taxes now. We've waited long enough, right?
Yeah, the government has to get its pound of flesh somehow, some
Yeah.
way. And so the RMD age used to be 72, and it's now moving up to 73. Why? Because people are living longer. And second, because we're going to need to have these people take out income over a longer period of time and recapture that.
Yeah, and I think that's significant because in the past, most people's biggest asset was their home. That is generally not always true anymore. Now it's retirement plans, and that's where this is going to impact people. 401k, IRA, 403b, all these accounts that are pre-tax dollars. I tell everyone, you got to look at those and think it's like a house with a mortgage. What's the mortgage? Taxes. You're gonna pay it.
Okay, so you brought this up, and I'm gonna double down on it. Okay, so Secure 2.0. Let me just context for the listener. Secure 2.0, introduced in 2019, reintroduced in 2022 with lots of new rules around it. It's really an awful onus on the financial advisor and on the tax accountant. Why? Because there's all these little unique mannerism type rules that come into play, and it gets super complicated.
Yeah.
One of which is that IRA rule. We used to tell people, load up those IRAs, load up those 401ks, because you'll use what you use and you'll just pay taxes as you pull it out. That's a wonderful deal. And then when your kids get it, they can wait over their lifetime to take it out and pay it off. And it was a wonderful deal. We were all in la la land until 2022.
Yep.
And they changed the rules. And now that IRA, that 401k, those kids, they're probably in their highest tax bracket when they inherit it from you. They have to pay taxes on that stupid thing every single year. So here's my question for you two geniuses in the room. Would you encourage your clients to have an IRA or 401k?
It depends.
Absent the employer match for the tax deduction.
Yeah. It depends. I mean, because it's still about tax bracket management.
Yeah.
So are you
But
going
is
to
it
pay
long-term
tax
or short-term?
You have to look long term. I mean, most people will look at it short term. They want to relieve pain now.
Yeah.
My income tax is killing me this year. But you've got to look at it from the perspective of what's going to happen over the lifetime of that account.
It's about the balance. It's about the implication. Everybody loves a tax write-off today.
Mm-hmm.
However, when I'm seeing portfolios come through and we're trying to create these tailored strategies for your clients that have all the right elements to it, it becomes a little bit challenging when we have this golden plated problem of people having deferred so much early on
Yep.
without considering the implications of the fact that these assets grow and grow quickly. Now, these qualified plans, which you're going to have to pay the piper, pay the tax on them someday, are now represent 50, 60, 70, 80% of clients' liquid net worth.
Yeah.
Challenging. So balance is key.
Balance is key. I'm really pushing all my clients to seriously consider Roth conversion.
Perfect.
Your tax rate is probably lower than what it will be for your kids. And they're going to be in their top tax brackets likely when they inherit it. What does that do to them? So it's not just about this year's tax plan. It's not even just about your lifetime's tax plan. Now we start looking at the entire family's tax strategy. Complicated stuff. Very complicated stuff. So Roth conversions is a conversation. Let's talk about 529 plans and that golden goose that we were just given, that gift. John, can you
Yeah,
talk us
they
through
just changed. They
529s?
changed that last year. 529s are designed to be for higher education. Well, actually, it's secondary and higher education. So it functions like a Roth IRA. So think of it as you put money in, after tax money, and then if it grows, as long as you can justify the expense of education, no taxes.
Yeah.
Now, what if you have a child that says, you know what, I'm not going to school? Or a child that says, you know, I got the presidential scholar. One of my tennis players got that.
Oh, wow.
Which is great. Anyway, so what if they don't use it? So the 529, yes, it serves the purpose for education. The one thing to remember is you as the controlling person on that 529, the first thing you can do is change the beneficiary. Yeah. In other words, I can move it from one of my children to another if I choose to. Now, some people will say, no, but I've designated it for that child. So I don't want to move it to someone else. It's not fair.
Yep.
You know. So what are the options I have? Well, pull it out, pay tax, and maybe some penalty. That's not the best option. The other thing that was instituted, I believe, last year was the ability to convert that money from a 529 to a Roth IRA for that child. So that's a really attractive thing. But remember, that is long-term money. That is money that's going to be there for retirement. And for a lot of these 20, 22, 23-year-olds, their problems are now. They're not later. I mean, everyone assumes the younger people should take more risk. Well, I don't know if that's true all the time. You know, they need to pay tuition. They're going to start a family. They're going to have student loans to pay back. They're going to have a mortgage coming up. They need a car once in a while. They have a lot of immediate objectives. And so how we manage the 529 is really important in terms of what is the money going to do?
For sure. So that's a consideration, but a great benefit to be able to take that 529 and say, hey, let's make it a Roth.
Yeah.
All kinds of things go within a Roth.
The long-term tax-free growth implications of that are really compelling.
Mm-hmm.
So I mentioned before, I'm a big fan of family tax planning. And I mentioned it's because of the tax brackets the kids could be in during their lifetime and when they inherit it. I want to talk a little bit about Roth IRA conversion and some of the benefits there. So these are the things that I'm telling my clients. Contradict me, jump in. I like the idea that it's going to lower their overall income tax over the long term, not that year. Right. So the equation I'm doing with my people is I'm saying, I need to see your tax statement from the most recent year. And then we're going to look back and say, what's different this year? And we're going to say, what can we do to fill up that bucket? I don't want to go to the next bracket. I'm trying to keep you underneath the next bracket for two reasons. One, I don't want you to pay more taxes. But two, if you're retired, I don't want you to have more medical charges. Medicare charges is what I said there.
Yeah.
So I want to convert as much as we can up to the end of the bucket. Then I want the tax-free to start compounding. Now, arguably, is the amount better or worse in the long run when it's probably similar. It's very similar. But there's no RMDs on a Roth IRA. Right. That's a beautiful thing, especially if I'm not using that money. And many of my people are frugal and thrifty enough that they don't need their savings. Mm-hmm. So they're forced into paying more taxes than they needed to. And finally, it's that last step. It's your kids, your grandkids. They don't have to pay required minimum distributions or have increased taxes in their long run. So those are the reasons why I like it.
Let me add one to that. Yeah. And that is, if while you're in your working lifetime, if you can figure out a way to transition money into Roth IRA, the big strength in that is if you hit retirement and you say, okay, taxes, where are they going to go? They're either going to go up, down, or stay the same. Doesn't matter. If you have one bucket that's tax-free and one bucket that's taxable, what does that give me the ability to do? Take the taxable to a certain point where it makes perfect sense and stop. And then whatever else I need, tax-free. I'm choosing my tax bracket in that circumstance.
And what you're saying is you get to do the proactive planning now, so that way you can choose what the pain point is and not exacerbate it by jumping into the next level.
That's
correct?
it. That's
The big challenge is what I share with clients is Roth conversions are a lot like a big box of Oreos. You know, they're really, first few are really good, but there's a point when you're going to want to stop.
That never happened.
And
I don't know.
it never happens for him.
I think I've found that much.
See, he goes to the top bracket.
Okay,
I know.
enough about Oreos. Here we are on tax tip number 4, bunching your expenses, especially like charitable contributions. Lots of people in Utah are very charitable. They give away, but we have these huge standard deductions. And so the charitable contributions usually not used as well. And there's RMDs into effect there. What do we do here? What do you guys tell them to do?
Well, if you're in a circumstance where the standard deduction is what you're going to take, that's the best. It's better than anything you do on individual deductions. Then what you can do is you can say, first of all, if I have to take a required minimum distribution because I've reached that magic age, number one thing is, can I give that as my charitable contributions? Now, what that does is instead of coming into me as a taxable event, it goes straight to the charity, no taxes. So I don't have to report it as taxable income. And I couldn't take the benefit of giving a donation because I'm doing the standard deduction. So it makes perfect sense to say, if you're going to, and I tell clients this all the time, if you're at that point of required minimum distributions, do not give donations with cash. Give it with your retirement account. And if you go through all
And
your
that's called what is the technical term for that? A qualified charitable donation, a QCD. When we talk about it, we say, hey, we had to do a QCD into a DAF because we love acronyms. A qualified charitable donation into a donor advised fund, your own charity, right?
Yeah.
Okay. So that's one of the things we want to do. We want to lump up all those in given years. Maybe you have a better year than worse year. Let's take that qualified charitable donation out of your retirement account.
Yeah.
And let's move it into your donor advised fund. And then you can give to the charities over time, but you got the tax deduction that year.
Right. And then for those of you that are younger than 70 and a half, 72, 73, 74, 75, and you're not in that era of required distributions, appreciated stock, appreciated shares of securities, or even anything. It could be land, but you can gift that to charity. The charity will not pay the tax, but you would. That's a good advantage.
Okay, that's enough free tax tips for today. Let's just kind of wrap this up. One of the things I want you to know as we walk out of this presentation, 4 or 5 really, really great tax strategies there. But the tax laws are changing. For sure they're changing. The tax code's 88,000 pages long, and it's written in pencil. The IRS and the Congress change it all the time and enforce it differently. So the important thing is, let's talk. Let's do proactive, not reactive tax planning, okay? That's our big deal. And that is all we have to say about that, as Forrest would say.
Well done.
Thanks for coming. We appreciate your time. Tune in next time. And if you like the show, share it with a friend.
Wealth Advocates is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of Wealth Advocates by the SEC, nor does it indicate that Wealth Advocates has attained a particular level of skill or ability. This material prepared by Wealth Advocates is for informational purposes only. It is not intended to serve as a substitute for personalized investment advice or as a recommendation or solicitation of any particular security, strategy, or investment product. Opinions expressed by Wealth Advocates are based on economic or market conditions at the time this material was written. Facts presented have been obtained by sources believed to be reliable. Wealth Advocates, however, cannot guarantee the accuracy or completeness of such information, and certain information presented here may have been condensed or summarized from its original source. Wealth Advocates does not provide tax or legal advice, and nothing contained in these materials should be taken as tax or legal advice. Please consult with your tax professional regarding your particular situation before implementing any strategies discussed. Advisory services are only offered to clients or prospective clients where Strategic Advocates and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Strategic Advocates unless a client service agreement is in place. Strategic Advocates LLC is a registered investment advisor. Please visit our websites at www.wealth-advocates.com or www.strati.co for important disclosures. Securities offered through registered representatives of Creative One Securities, a broker/dealer, member FINRA/SIPC. Advisory services offered through Strategic Advocates LLC, a registered investment advisor. Strategic Advocates LLC, Wealth Advocates, and Creative One Securities are separate entities. Wealth Advocates is located at 255 South Main Street, Suite 140, Logan, Utah, 84321.